In the last few decades, dozens of Indian airlines have tried to conquer the skies. Most of them have failed. Kingfisher, Jet Airways, Go First, formerly known as Go Air, the graveyard is full. Yet today, India is projected to be one of the fastest growing aviation markets in the world all the way to 2053. So how do you invest in a sector that is growing so quickly but kills almost everyone who tries to play in it? Welcome to the brutal economics of Indian aviation. Today we are breaking down why running an airline is one of the worst businesses in the world, why IndiGo is the only one consistently making money, and why the smartest investors aren't only buying airline stocks, they're investing in the infrastructure around aviation. Let's start with the scale of what's happening. According to International Air Transport Association, IATA's World Air Transport Statistics, in a typical year, most Indians don't fly even once. China is roughly 4 to 5 times higher, and the US is more than 10 times higher than India. India and China have roughly the same population, but in 2024, India handled 211 million passengers while China handled almost 741 million passengers. That gap is not just a number. It represents hundreds of millions of Indians who are yet to fly. And the airlines can see this coming. After all, IndiGo Airlines is Airbus's largest customer in the world, with more than 1,300 aircraft on order today. Air India has another 344 Airbus aircraft sitting in the backlog. Their order books are locked up well into the 2030s. But having planes does not automatically mean you'll make money. The highest cost for any airline is fuel. Globally, the Aviation Turbine Fuel, ATF, accounts for roughly 30% of operating expenses. In India, depending on the airline and the year, it normally runs between 30 to 50% of total costs. But because of the recent West Asia crisis, airlines and industry bodies now say fuel has climbed to around 60% of total expenses for some Indian carriers. That's also why from June 1st, 26, Air India and IndiGo are cutting domestic flights for roughly 90 days, explicitly citing soaring ATF prices and weak yields. So when more than half of your cost base is something you don't control, that's really not a business model. That's a hosted situation for shareholders. And then comes the tax trap. When the government rolled out GST in 2017, it kept ATF outside the GST slabs. Hang on, that does not mean that ATF is tax-free. It just means it's not taxed under GST. So the GST credit mechanism never kicks in for them. Instead, airlines pay central excise duty on fuel and then state VAT on top of that, with each state deciding its own rate. Tamil Nadu is around 29%, West Bengal is 25% plus an extra levy, while some smaller states charge as low as 1 to 4% to attract traffic. Now put yourself in the CFO's chair. When an automaker buys steel, it pays GST on that steel and then nets that tax off against the GST it charges on the car. With ATF, airlines can't do that. They pay VAT and excise on every litre of fuel, then charge GST on tickets. And because those sit in different tax systems, the fuel taxes cannot be set off against the GST they collect from passengers. Every litre burned is a pure cost with no input credit and nothing to reclaim. Prices spiked. Delhi cut ATF VAT from 25% to 7%, and Maharashtra cut Mumbai's rate from 18% to 7%, but only for 6 months. That gives temporary relief. It does not fix the structural problem. So you're looking at world-class fuel prices plus some of the world's nastiest fuel taxes with no input credit back. From an investor's lens, that means your cost line is volatile, elevated, and largely outside management control. This brings us to the most dangerous concept in aviation, operating leverage. An aircraft flying from Delhi to Mumbai costs nearly the same to operate whether 130 seats are sold or 175 seats. Fuel, pilot salaries, landing fees, lease payments, most of these costs don't move with passenger numbers. In aviation, that operating leverage is unforgiving. When it meets a high fuel cost structure, the margin for error almost disappears. Kingfisher Airlines is a classic case. After it acquired loss-making Air Deccan, it tried to run two opposite models under one roof. The cost structure of a premium carrier with the fares of a budget airline. It never became sustainably profitable, piled up well over 10,000 crore of debt and losses, and by 2012, its flying license had been suspended and was then allowed to lapse. Fast forward to today. For years, IndiGo and Air India have been the two big survivors in the Indian skies, with IndiGo holding just over half of the market share according to OAG data. In financial year 25, IndiGo reported profit of 7,258 crore, while Air India reported a 10,859 crore consolidated loss. That's a gap of roughly 18,000 crore between the two airlines that are flying the same routes, paying the same or similar ATF prices, and facing the same regulators. IndiGo's profitability is a deliberately thought out, simple business model. One primary aircraft family, it relies on the A320 family, one maintenance system, one inventory of spare parts, and aggressive sale and lease back to keep aircraft ownership off its own balance sheet. In aviation languages, two metrics decide who lives and who dies. One is RASK, which is revenue per available seat kilometer, and this tells you how much money every airline earns for every seat it flies for 1 kilometer. So whether that seat is actually filled or not. So if RASK goes up, the airline is earning more revenue per unit. And the second metric is CASK, cost per available seat kilometer. This tells you how much it costs the airline to fly one seat for 1 kilometer. Again, whether it's filled or empty. So if CASK goes down, the airline is getting more efficient. IndiGo's CASK, its cost per seat per kilometer, is structurally lower than weaker rivals. From an investor's point of view, this is the real punchline. All of that fuel volatility, tax distortion, and brutal operating leverage sits inside the airline's P&L. Airlines are stuck with high fixed costs and almost no pricing power. The more durable, contract-driven cash flows are actually outside the airlines, in the airports that collect the fees every time a plane lands, in the MRO, which is the maintenance, repair, and overhaul players that service every aircraft year after year, and in the other infrastructure systems around aviation. Take GMR airports. In financial year 26, GMR's airport business reported its first annual profit in over a decade, with revenue jumping about 40% to roughly 15,200 crore as traffic recovered and tariffs were raised. India's aircraft MRO market is already around $4 billion and is projected to grow roughly to around 5.7 to 6 billion by 2030. Every new aircraft IndiGo or Air India takes delivery of must keep coming back to this ecosystem for the next 20 years. These are the toll booth businesses on the highway in the sky. The planes can change, but the toll booth does not. Let's look at the same thing from another angle. UDAN, Ude Desh Ka Aam Nagrik, the government's regional connectivity scheme that subsidizes flights to smaller towns so ordinary Indians can afford to fly. On paper, that should have created a new profitable layer of demand for airlines. In reality, well, by 2025, 649 routes had been operationalized under the scheme, but only about 7% of routes sustained operations after the 3-year subsidy window ended. So instead of unlocking a durable new market, UDAN ended up exposing how fragile and subsidy-dependent India's regional aviation boom really is. Alright, let's get specific on how all of this affects you as an investor. First, if you already own airline stocks, treat any airline that's making steady profits today as the exception, not the rule. Over the last decade, very few Indian airlines have made money through a full cycle. Most have either gone under, been rescued, or constantly diluted shareholder value. Even the best run carrier is still exposed to the same three things. Fuel prices, it does not control. Taxes, it cannot reclaim. And brutal operating leverage that can flip profits to losses in one bad quarter. So instead of fixating on the share price, focus on two operating signals over time. Monitor the trend in cost per seat kilometer CASK and the trend in load factors. If costs keep climbing while planes are not getting fuller, the business is losing operating leverage and the equity story becomes fragile no matter what the stock is doing that month. Second, if you own weaker or heavily stressed out airline stocks, ask a simpler question to yourself. Is this a business with a clear path to covering its cost of capital, or am I just funding working capital in the hope of a possible turnaround? History in India and globally is full of airline stories that looked cheap on the screen right before they went into restructuring, heavy dilution, or bankruptcy. A low share price is not the same as low risk. Of course, unless it's backed up by visibility of fresh capital, a credible plan to lower CASK, and a realistic route network that can actually make money at current ATF prices. Third, if you own airport or infrastructure players, this is where the toll booth logic kicks in. Airport operators and related infrastructure players get paid every time a passenger walks through the terminal or a plane lands, regardless of which airline brought them there. As traffic recovers, you see it straight away in aero charges, non-aero revenue, and real estate income, which is why some large airport platforms are now reporting their first meaningful profits in years on almost 30 to 40% revenue growth. So what are the risks here then? Well, regulation and tariff resets, capex overruns, and political interference in user charges. But at a structural level, these businesses are tied to overall traffic growth, not to the knife-edge economics of any one airline. Fourth, if you're thinking of entering the aviation sector now, you could consider following an order of preference. Airports and airport platforms that are effectively the toll booths. The revenue here is linked to passenger and aircraft movement with regulated but more stable cash flows. MRO players, maintenance, repair and overhaul players, the hangars, engineering shops, component specialists that get paid every time an aircraft needs a check, regardless of who owns it. Ground handling, catering, engineering services, the recurring, contract-driven services that keep turning up on every flight day after day. The strongest airline operator only if you understand that you are betting on execution in a hostile industry, not on a feel-good India aviation story. Everyone else, well, it's usually best avoided for long-term risk-adjusted returns. So what's the key insight in all of this? Credible projections now put India at around 500 million air passengers a year by 2030 and close to 1 billion by 2047. The market is almost certain to grow, but which airline survives to enjoy it is not certain. So if you want exposure to India's aviation story, you don't have to necessarily buy the companies locked in a price war in the sky with 60% fuel costs and politicians watching every fare hike. You can buy the concrete they land on, the tools that fix them, and the systems that build them. In Indian aviation, the businesses that get paid every time a plane moves, rather than only when a specific airline makes a profit. These are the ones that have the best shot at compounding your capital. I'm Yashodhara and you're watching DeKoder. If this video saved you from buying an airline stock at the wrong time, the subscribe button has already earned its place. And if you're still sitting in a loss in a weak airline hoping for a miraculous turnaround, at least now you know what you're really betting against. Like this video, share it with someone who thinks Indian aviation is booming. Automatically means airline stocks will boom. Those are two very different sentences. And I will see you next week.